Welcome everybody back. Okay, welcome back everybody. So today we have Felipe, who's going to tell us about micro macro dynamics of capital flows. I know most of you guys are veterans, but if you're new for today, the rules are, if you have a question during the seminar, feel free to just unmute yourself and jump in and interrupt just like you would in a regular seminar. If you feel more comfortable, you can use the raise your hand feature and then he can finish his thought and come back to you. If you have smaller questions or clarifying questions, Liliana will be in the chat room, so you can just send a chat to everybody with your question, and she'll be trying to handling those questions as well. I just posted a link to the slides in the group chat, so if you'd like to download a copy of his slides and move ahead or behind, they're there for you. Okay, Felipe, take it away.
Okay, thank you, Kim, and thank you all the organizers. It's really a pleasure to present here. So this is joint work with Liliana and Keimo. They should both be in the on the chat. And the usual disclaimer applied given that Keimo is visiting the data set. All right, so let's get started. Basically, what we want to study here is the effect of capital flows in the allocation of resources between sectors and within sectors. Understanding these requires a lot of data. In particular, you need firm-level data from the service sector. And that's the kind of data that has been very elusive. So typically, what we have in the literature is either macro models without firm-level data, where you try to infer things from aggregates, or models where you look within the manufacturing sector. But to really understand how the resources are shifting within and across sector, what you need is firm-level data from both services and manufacturing. But on top of that, what you're going to need is a clean experiment. In particular, for example, the experiment of a financial liberalization. So that's exactly what is on the menu for today. So what we're going to do is we're going to assess the impact of capital flows, and we're going to employ census-level data for Hungary, which is a pretty amazing database because basically you have every firm in the economy without a threshold of size. That includes firms in services, in agricultural, in manufacturing. But on top of having this data availability, you have as close as it gets in macro to a quasi-natural experiment. Basically, Hungary had a financial deregulation in 2001 that was the only major reform that year because it was a country that already has performed, for example, a trade liberalization. So we're going to get a clean experiment of capital inflows into this country, having the firm level data that we need to try to understand how things are moving. Now, given that, what we need is channels to think about and ways of identifying those channels in the data. So we're going to focus in two channels. The first one is what you would call the relative input cost channel. The idea is very simple. When you have a country that has capital controls and they decrease these capital controls, the interest rate of the country is going to decrease. And that's going to reduce the relative price of physical capital. Therefore, what you should expect is that firms that are in industries that are more capital intensive are going to see their marginal cost of production reduced by more. And therefore, that's going to be one of the channels that should reallocate resources between and across sectors. That's going to have to do with the capital intensity of the technology of the industry. But then there is a second channel. And that's a channel that I would say is the most novel channel that we're going to put forward. So the idea is the following. When you have a financial liberalization, also consumption jumps because you're able for the first time to separate investment and consumption decisions. So you're going to do consumption smoothing, and on top of that, you're going to be a bit richer because you're going to convert to your steady state faster. Now, your typical model says that consumption is going to increase basically in all of the goods kind of proportionally, with small differences coming from relative prices. But what we have been learning from the literature is that there is a rich heterogeneity in terms of the expenditure elasticity across different goods. So what you should expect is that firms that produce goods that are more income elastic, at least on impact, are going to benefit much more from the financial liberalization. And those are basically the two channels that we're gonna explore. And the main idea is that we're going to use this financial liberalization as a quasi-natural experiment, and what you're going to see in the empirics are basically difference in difference estimations. Now, what else are we going to do? We're going to build a small open economy model that is going to help us to understand the contribution of these two channels and the forces that are at play. So it's going to be a model with two sectors. You're going to have manufacturing and services, and both sectors are going to have heterogeneous firms. Now, why these two sectors? Well, because when we go to the data, you're going to see that manufacturing industries are more capital intensive, but they tend to have lower income elasticity. So the two forces go in opposite directions. So it's very interesting to have a model to try to understand which force dominates and which is responsible for the reallocation between and across sector. And then in this model, what we're going to do is we're going to study a transition on an economy that is in financial autarky, but is open to trade, just that the trade has to be balanced. And then we're going to hit it with a financial liberalization, and we're going to study the transition of this economy. So it has a little bit of trade, this paper, in the sense that you're going to see a Malitz model with endogenous entry and exit from exporting in the tradable sector, but it's also a deep-rooted model in international finance, because this is a dynamic model with rational expectation, the full transition, and the Euler equation is determining the dynamics of the current account and the trade balance. So the trade balance and the current account are fully endogenous. And then what we're going to do is we're going to study the allocation of these flows between and across sector, and I'm going to show you that the new channel, the one that relies on the expenditure elasticities, is key to understand both the short-run effects and the long-run effects of the financial liberalization. Let me give you a preview of the main results, and then we just dive in. So in terms of empirics, I'm going to group the results in three packages if you want. First, I'm going to show you some firm-level analysis. Then what you're going to see is that the firms that are in more capital-intensive industries are going to increase their value added. Whenever I say value added, you can think about employment or capital. Everything is going to carry through, but I'm going to focus the presentation on the value added. You're also going to see that firms that are in more high expenditure elasticity industries are going to increase their value added. Then we're going to aggregate a bit, and we're going to go at the industry level, and we're going to try to see the extensive margin, because one of the big advantages of having a model with firm heterogeneity is to understand the entry and exit margin. And you're going to see that a lot of the action in the data is coming from what would be in a Malitz model, movements in the cutoff and the mass of firms that are producing, both across sectors and within them. Then the final thing that we're going to do in the empirics is aggregate a little bit more, given that the model is going to be a model about services and manufacturing. And I'm going to show you that on aggregate, it seems that the services are benefiting more. So basically, the expenditure channel on impact is more powerful than the cost channel. And then we're going to look at the model. I'm going to validate the model, although the model is not done for hardcore quantitative work. It does quite well in terms of understanding the effect of the liberalization. And then one of the things that I like about the model is that we will be able to see that these liberalizations might have permanent effects. So they not only affect the transition of the economy, but they can have permanent effect in the long run, because these economies would have to serve the debt that they acquired during the liberalization, and that's going to change the incentive for exporting, and that's going to change the reallocation of resources permanently across and within sectors. Okay, so that's it. Financial liberalization. So let's look at the reform in Hungary in 2 slides. And remember, the expert is in the room. So any questions that you have, you can direct them to Liliana in terms of the Hungarian reform. So basically what you have is that in 2001, Hungary deregulated the capital controls, and that led to a lot of capital inflows. So what you have in this graph in the left here is the financial account, and what you see is an increase in net inflows by basically 4 times. If you look at the other macro objects that you would like to see in a financial liberalization, everything goes in the way that you expect. Basically, the net foreign asset decrease, you get an increase in the credit to GDP ratio, the interest rate drops by 12 basis points, and of course you see a sizable increase in consumption to GDP coming from this idea of consumption smoothing that is going to be very important when we understand the expenditure effect. So that's basically the reform, and what we're going to do is to see changes before and after this cutoff. So what's the database? The database is this APEH, which is basically the census of all the firms in the economy, and it covers 95 to 2008. When you look in the appendix in the paper, you're going to see that basically we have 95% of the employment in everything, in agriculture, manufacturing, or services. I have worked with databases of census of manufacturing in Chile and in other places. You never get numbers like this. So it's a pretty wide coverage. We are going to focus on firms that have at least 4 employees, because basically you want to remove a little bit of the noise of those firms that are not actually firms. The identification strategy is going to be a diff and diff, and basically that tells you that we're going to exploit 3 sources of variation. One is time, another 2 have to do with cross-sectional. So the time is going to come from the reform. So basically, as I already told you, we're going to take this reform as the event in 2009, the big thing that changed, which led to these capital inflows. But then we're going to exploit the reaction to this reform across different characteristics of industries. The first one will have to do with the cross-sectional differences in capital elasticity. So here what we did was estimating production functions at the 4-digit level. And basically there what you have is a number that tells you how reliant on capital is the production at different 4-digit levels. Now, the other variation that we exploit has to do with the demand. So basically we want to know if the goods that the firms are producing are more income elastic or not, or have a higher expenditure elasticity. What we did is we took the 2-digit elasticities estimated by Mark Beals and co-authors with in order to try to exploit the differences at 2-digit. You're going to see that sometimes we're going to put sector-specific trends. So I want to say this now so that you understand it. Given that we have, for example, 4-digit levels in this class of regressions, whenever I say that there are sector time trends, it's going to have to be a 3-digit times time, and in this case, 1-digit cross time, because basically otherwise I suck on all the variation. Good.
So let me
yes.
just ask 2 quick questions. The first view is that we're thinking that all the previous reforms in Hungary have washed out by now in 2000. You know, like the trade reforms, the end of the Soviet Union, all that stuff is, you're in steady state in 2000? Is there any, that's the assumption?
So basically in the appendix, one of the things that we do is to try to look at the flows. Let me try to find it.
That's fine, it can just be yes or
yes.
No.
So basically that's what we assume, but we have an appendix where we check this and we look, for example, at the trade flows, and there is no jump on trade on impact on the reform. There is a little bit, of course, of a trend later on.
When you're going to go to the model, are you going to be starting from steady state, or are you on some transition path? And I just wanted to.
Very good, very good.
I just wanted to know. I mean, you know, that's a recession year also.
Very good, very good. So we're gonna start the economy at far from the steady state. In fact, the economy is going to be with a level of capital that is 60% of the steady state at the moment that the reform hits. And that's calibrated to have a similar pattern like the amount of capital that Hungary had with respect to countries like Austria, for example.
So it's going to be on some transition path.
Absolutely.
And then you're going to be changing the steady state.
Absolutely.
The second question was, you've used this like expenditure elasticity a bunch of times. Are you thinking about like the cyclicality of goods, or just how your spending on something changes with your kind of wealth or lifetime income?
Yes, lifetime income or wealth is a better way of thinking about it, George. So these are elasticities that are going to be constant. Think of these as non-homothetic preferences.
And so why are these shocks having like why are these shocks having a big impact on lifetime wealth? You know, like in a standard trade model, a big trade liberalization would only affect your lifetime wealth 2% or 3%. So why is, you know, I can see like cyclical stuff, but why are you focused on this wealth channel when these shocks should have a small impact?
Let's see when we get into the model, you're going to see, and then we can see if you think that the impact is small or large. I prefer to discuss that with the numbers there. But basically, this is going to allow you to jump to the steady state faster. Okay. The welfare numbers that I don't have them for you today are in line with what you typically get in models of financial liberalization. So I don't think that our numbers are off. It's just that we will be able to explain patterns in the data that you couldn't explain without these heterogeneous income elasticities. Okay. So let's take a look at that.
Right.
Good, thank you. All right, let me show you a bit about the empirical design, and some of this can shed some light about the heterogeneous income elasticity and the question that George was asking. So the preferences that we're going to use, and we're going to go back to the model, this is just to motivate the empirical design, are basically non-homothetic preferences a la Coming et al. So what do you have in these kind of preferences is you could think of it as a generalization of a constant elasticity of substitution aggregator. So what you lose is that you actually don't have closed form solution, but what you get is that with one parameter, you can actually parameterize how the demand for one particular good is going to react to an overall increase in wealth, or in this case, an overall increase in expenditure. So this is exactly what George was asking. So when we think about heterogeneous income, heterogeneous expenditure elasticities, we're talking about different sectors have different EJ parameters. If you do your algebra here, you will be able to derive the demand. And then what I'm going to do is I'm going to combine it with the production function. And with that, I'm going to motivate the regression that we're going to use. So the production function that we're going to be using in this model is going to be a constant return to scale production function where the parameter alpha is going to parameterize the capital intensity. So basically here what you see is the force of the heterogeneous expenditure elasticity, and here what you see is the force of the heterogeneous capital elasticity. The relevant cost, as you know, in this class of model is going to be a function of the interest rate on the wage, and that's going to be this phi. Now, this is what I was telling you. If you look at the demand and you use the production function in the monomolistic competition setup, what you end up getting is an expression like this one. So what's the big difference with respect to the non-homothetic case is the fact that different goods are going to react differently to total expenditure. Some of the goods are going to increase more than proportionally, and others are going to increase less than proportionally, even taking into account changes in relative prices. That's what non-homotheticity is giving you. And then what we want to separate here, what we want to understand and identify is the heterogeneity across industries in terms of the input cost and heterogeneity across industries in terms of the expenditure elasticity. So what we're going to do is we're going to take logs, group some terms, and you're going to get an expression that looks a little bit like this. Basically, the input cost channel is going to depend on the relative price of capital and wages. And what we know is that in the liberalization, this term is going to drop. And then you have that also your demand is going to react to the aggregate expenditure in the economy. That's going to be captured by this guy here. And then all of these other terms that are grouped from the demand that we saw before, we're going to absorb them with different fixed effects. And then the experiment is going to be as follows. We're going to have this, you could think of this as the treatment, which is the financial liberalization, a variable that is 0 up to the point of the liberalization, and then is 1 thereafter. And then we're going to see how firms that are in a given industry characterized by a given technology or a given demand react with respect to themselves, how their path changes when the financial liberalization hits. And that's basically the equation that I will be estimating at the firm level, at the industry level, and then at the sector level. Okay? So let's get to that.
A quick comment, Felipe.
Yes.
I think Corin, Halpern, and Schweidel made a big point about intermediate inputs in the liberalization. You're ignoring intermediates here.
That's correct, Jonathan. That's one of the things that we're ignoring.
Okay.
We could extend the model eventually. If a referee wants us, we do it.
Yeah.
So can I ask a question?
Yes.
Go back to that, I guess like the demand equation. So this is consumption at home. No, go back to the one you were just estimating.
Yep.
This one right here. That's consumption at home. That's domestic demand in that industry. But then there should be another term for whether I export or not. Don't I
Yes,
care
so
about
in the
how
model,
fast the markets I'm selling in?
exactly. So what you have here is the motivation for the regression that we're going to look at. In the full model, you're going to get that effect too. You're going to get that the firms in the manufacturing sector are exporting. Here, the main idea was to try to see the within firm changes. Of course, you could have changes in the margin of the fraction of firms that decide to export, and that's a regression that we used to run and we might include again. But if the status of the firm doesn't change, the firm fixed effect would take care of the exporting part. So the issue is the firm that between the liberalization start exporting.
I don't think that's right. I mean, if the share that you're exporting is changing for whatever reason, then the firm fixed effect is not, I don't think picks it up.
Okay, okay. No, but that's something that that we can check. But basically, the idea of this is to motivate the regression in the model. That force, of course, is going to be there.
Okay.
Good point. Okay, so let's look first at the firm level analysis. So basically, here what I'm showing you is the result of the regression that we just discussed. The only difference across these different specifications, it's the level of the fixed effect. So the first one, we do just firm and year. The second one, we do sector and year to absorb all of the things that we were discussing before. And then on top of that, we also include the price index, because in the equation, as you saw, there was a price index going on. If you want to focus in one column, we can focus on the third one, that is the most collapse, in some sense, regression. And then what you're going to see is that firms in more capital-intensive industries are going to increase their value added, exactly as we said, because basically their marginal cost is decreasing more relative to other firms, and therefore they face an expansionary force. Then if we run a regression, yes, no? Then if we run a regression with the expenditure elasticity, you see exactly the same effect. So here, without thinking about the input channel, where we're thinking is the demand part, and you see that whenever you're selling goods that are more income elastic, whenever you experience the liberalization, you end up expanding your value added. You end up selling more. Now, you could think that these two things are correlated, and in some sense, they're measuring the same thing. So what we do is we include both at the same times, and you see that the coefficients barely change. The significance also barely change. So these are two independent effects, which is what we will be making a big deal of in the model. Then what we do is we go for the industry level analysis. So here, what you're going to see in different columns are the number of firms in the industry, the firm size, the average firm size of the industry, the average revenue TFP of the firms in the industry, and the producing price index. Because as you know, in these liberalizations, you expect prices to move. And what do we get? Well, we get that in industries where the expenditure elasticity is higher, you get an increase in the number of firms. You get that the average firms start being smaller. What these two things are pointing out is that you get a lot of entry into these high income elastic sectors, and the entry is driven by smaller firms. And what you get is that a non-significant reduction in TFP. Basically, there is not much to do with the average productivity in this regression. And you see an increase in the price. So this is exactly what you would expect if you think that these guys are in fact in services, as I'm going to tell you before. So you get a lot of entry of small firms in services that are low productive, and the price of services go up. The story in the capital-intensive industries is a little bit the opposite. So basically, you get more concentration. You get less firms. The average firm size increases. And then what you get is that the average productivity increases. So what is this telling you? This tells you that there is a lot of reallocation within industry through large productive firms and exporters. And that's going to kick in later on in during the transition. So having shown you the aggregate of the industry, let's focus a little bit more in the extensive margin, because I was telling you that some of the big effects are going to come from this margin. What do you get when you look at the entrance in particular? You get an increase in net entry, due to the expenditure elasticity, and you get this decrease in the productivity of the entrant. So the way I want you to think about this is that in industries that are characterized by high expenditure elasticity, the increase in demand is going to move the operation cutoff in your model to the left. So you're going to get a lot of entry of small firms that are less productive. Now, in capital intensive industries, what you're going to see is a little bit different. You're going to see that it seems that the number of entrants is not changing that much, but you get quite a bit of concentration among more productive firms. Okay? That's the rushing version of the empirics. There is a little bit more to show. Let me show you this graph, because this graph is very cool before we move on. So what you have here is the following. Let's concentrate in the graph that looks at the number of net entrants, but the story for entrants is going to be the same. Here you have all the industries in the economy rank with their income elasticity. And here what you have is the number of entrants for these different industries when you do an average before the liberalization. What you see is that there is little difference and little effect in terms of the income elasticity with the entry of firms before the liberalization. But in the period right after the liberalization, this starts being very meaningful. And you start seeing that there is a lot of entry exactly in the sectors that have the higher income elasticity. So this also tells you a bit, and that's something that you can see in the appendix, that we don't have pre-trends. So basically the income elasticity, there were not big changes in industries before the liberalization, but as soon as the liberalization hits, you get this separation with a lot of entry exactly where we would be predicting. And the last thing that I wanted to show you, what I was telling you, is the model is going to have manufacturing and services. In terms of manufacturing, you're going to see that manufacturing is more capital intensive compared to services. And the services have a high expenditure elasticity compared to manufacturing. And then the question is what's going to win? What you could do is to run, think of this regression as local projection. It's kind of it. What you can see here is a different horizon, how the relative share is moving. And you see that the relative share in value added of services is increasing and is significant. The same thing for employment. And that's also what's going to come from the model. You're going to see that it is services, at least on impact, that is going to start concentrating more resources. But in the long run, the effect is going to be different. And that's also what is cool about having a model, because the data starts far before we can call this transition over. Okay, yes?
Your firms are heterogeneous in their capital share?
No, well, in different, so the firms are going to be heterogeneous in their capital share in the model when you compare manufacturing to services. In the data, we allow for differences of that at the 4-digit level. So the data has more granularity.
So when we see an RTPF measure, it's across firms with the same capital elasticity.
So Liliana can correct me if I'm wrong, but what I recall that we did is we calculate that at the 4-digit level. And then after you have the measure at the 4-digit level, you can aggregate it with the weights. That's typically how it's done.
Okay.
Very good. Okay, so.
Felipe, can I ask one more question? This is not so relevant for the firm level stuff because you guys have year effects, but for the last couple of things that you showed us, actually, we were explicitly looking at the time series. Have you guys looked at how the sectoral productivity growth rates look in the before and after period? I guess I'm just wondering whether, you could see also, as well as this, policy change, potentially a break in sectoral productivity growth rates. If we see manufacturing productivity growth start to pick up post 2001, that would also explain a lot of the stuff that you've just shown.
Yeah, so I know that we have an appendix where we look at the pre-trends in the aggregates. I don't know if we have the plot that you want.
Okay,
see, but,
it's something to think about.
But something that we can think and that we could include. Good.
I have a question.
Yes.
So I don't know what happened in Hungary, so that's the question. But like in India, for example, part of the liberalization was access to foreign-made inputs. So before the liberalization in India, you couldn't actually get foreign exchange without having exported something. So it used to be very difficult. Is this part of what happened in Hungary? Because if that was what happened, if it was easier to get foreign exchange to buy intermediate inputs, then the share of sort of foreign, of, you know, later on foreign dependence on foreign intermediate inputs would also be a factor in terms of how the sector responded.
Yeah, I understand. So one of the good things in Hungary is that Hungary had no restriction to trade before the liberalization. So basically you were able to import whatever you wanted. What the liberalization is going to do, and it's going to interact with trade, of course, and that's why we have here a dynamic trade model, is the fact that you will be allowed for the first time to have trading balances. And that's gonna impact the evolution. But here there's nothing that you were not able to import before or after. Okay? Very good.
So what exactly did the liberalization do? I mean, it removed capital controls, so it let you move your money abroad?
So there were restrictions in both the forward market and the spot market. Basically, international flows were completely closed. We have an appendix with the details. If you want, after the presentation is done, I in fact have slides on that and we can go in depth. But this is one of the costs of the 1 hour seminar. Okay, good.
Felipe,
Yes.
You're saying it's basically an aggregate effect and that it had no effect on individual firms other than through the interest rate or the cost of borrowing from capital, right?
That's the way we want to think about it. We want to think about this as something that is going to affect firms only through their changes in the demand that they face and the costs that they're going to face when they want to rent or buy capital. Yeah, exactly. Jonathan, you had a question?
No, I'm done.
Okay.
I have a question, which is just when I look at like the trade data and just thinking about it, I mean, Hungary kind of integrated into the European Union and the trade share of GDP doubled from 95 to 2000. And so you would think that that would have affected the manufacturing sector different than the non-manufacturing sector. And since one of the things you showed us was, you know, certain sectors had less entry than other sectors. I wonder how much of that is just the fact that a lot of the entry came in earlier in some sectors than other sectors. And so you might want to somehow control for what was going on in that pre-period to show us that that's not part of the story.
So we have some pre-trends, as I was saying, analysis in the appendix. I have to check if we have in the final version also the entry rates I think we had them, but Liliana can answer that over the chat, and if we don't, we can include them. That's a good thing to have. Very good. Okay, let me jump to the robustness tests and go to the model economy. Basically, the economy is going to be a small open economy. There's going to be transitioning to the financial autarky steady state. So absent any reform, this economy will never borrow along the transition. There's going to be two sectors, manufacturing and services. And then in order to assess this input and the consumption channel, what we're going to do is to build this difference across these sectors. So the manufacturing good is going to be the tradable good, and it's going to be more capital intensive. And the service goods are going to be non-tradables, and they're going to have this higher expenditure elasticity. So as George was foreseeing, there is another channel going on here, which is going to be the endogenous reaction of trade through the changes of the financial liberalization. And that channel is going to be very important in the medium and the long run. And that's basically a channel that I want the model to uncover a bit for us. Firms are going to be heterogeneous in each sector. Let's think of it as a Mailitz model. Let me go back to the preferences so that you see how they look now that we include these heterogeneous firms. So basically, your intertemporal preferences look like this with the typical curvature that you would put. But then the basket, instead of being your typical CES, is implicitly defined by this function. This nonlinear function, what it does, it gets you these demands that are going to react to the aggregate C that we discussed before. In particular, whenever this number is equal to this number and it's equal to 1, what you get is the CES function back, and you are back to that baseline model if you want. Now, what about the manufacturing bundle? The manufacturing bundle is going to be a CES aggregate of an imported basket and a domestically produced basket. This is the domestically produced basket, and this is the imported basket that is going to be summarized just by an exogenous price. Why do we need this? Well, because this model has an endogenous trade balance, and we need to have imports and exports. The imports are going to be these goods and also capital. We're going to assume that capital is imported. You could have a mixture between imported or not, and it's going to change a little bit the quantitative behavior, but not the main message of the model. And then what you have is that the basket of domestic manufacturing is your typical aggregation that you see in any trade model. Okay? You're going to have these for services, and you're going to have these for manufacturing. What about the budget constraints? Well, the representative household is going to spend on consumptions. It can be the domestic, the numeraire, which is the imported basket that we discussed before, also the basket of the services. It has to invest, and because, as I was telling you, this is in the foreign basket, all the capital is imported, that's why you don't see an extra price here. There is labor, there is the return to capital, there are the profits, and there is going to be transfer that has to do with the capital controls being given back or taken. Now, what is important here is that in this model, the current account, as I was telling you, is completely endogenous. So whenever you have the reform, you're going to have an Euler equation that is going to optimally decide the path for the debt. Okay. We can look at the demand functions, but all of that is also in the paper, and it's just some algebra. But let's go back to the two channels just to fix our ideas. So the first channel has to do with production. Firms are going to be heterogeneous in manufacturing versus services with respect to the intensity in capital, and that's going to be reflective in the relevant price or the relevant marginal cost that they care of. We're going to have a foreign demand. This is what George was asking that I was telling you in the model. It is there. Maybe we need to be more explicit when we do the derivation for the regressions. But from the perspective of the model, what we're going to assume for convenience is that the elasticity of the foreign demand to price is the same that the one you have internally, to avoid kinks in the demand and make the solution a little bit easier without loss of generality. There's going to be, as you imagine, fixed costs for producing and for exporting, and all the cutoffs are going to be endogenous. Especially in this audience, you know these value functions, you know exactly what's going on. This is where I'm taking time for the half an hour that George owes me. Then, in terms of the trade balance, this is what I was telling you before. This economy is importing these manufacturing goods, but it's also importing capital, and then you have the export of manufacturing, and that constitutes the trade balance. Whenever capital control are in place in a high manner so that the economy is in financial autarky, this thing has to be zero. But that means that this guy has to be equal to this guy. So going back to Carla's question, there can be trade before or after. What about capital controls? So the domestic interest rate is going to be a function of the foreign and exogenous interest rate. And there's just going to be a capital control conditional on you borrowing, okay? As for the ones of you that are familiar with international finance model, you need the trick to keep the model stationary. Think about Schmidt-Grohe and Uribe. And basically here what we have is an endogenous risk premium that is going to pin down the level of debt in the long run. But I'm not going to play with the risk premium term. I'm going to play with this tau, basically. So what you can imagine is that if tau is high enough, this economy will not borrow at all, and you're going to have a transition in full autarky. If this is low enough, you can have borrowing along the transition and even in the long run, which is the thing that we're going to emphasize. All of the markets clear. The only thing that I want here to point to you is the current account. So the current account is going to be, of course, linked to the trade balance. And that's going to imply that if in the long run you have debt, you would have to pay that debt by exporting. And that implies that if the liberalization is large enough to affect the long run level of debt, it would require a different allocation in the long run in order to support the positive trade balance that is going to be needed. Good. So let me go a little bit quick here on the calibration. The main thing that is important in the calibration is that the model reflects the difference between manufacturing and services in terms of the income expenditure elasticities. And it also reflects the differences in terms of the capital elasticity. The rest of the thing that we put discipline on is we try to get firm distribution that looks similar. The calibration is done without capital control, thinking at the long run of Hungary. Okay, good. Now, what's going to be the financial liberalization experiment? So the idea is that if you think about the decision of borrowing, let's imagine that you're in that initial point. So George was asking me, are you going to start at the steady state? No. So you're going to start with some level of capital. In any model, what you would do is you would evaluate the net return to capital given your capital stock and the depreciation rate. And you would borrow if this is lower than the cost of borrowing. In the margin, when B is equal to 0, the risk premium is 0. And the capital control term is also 0. So when you are in the margin, what determines if you're going to borrow an epsilon amount is if this thing is lower than that thing. If that's the case, if this thing is lower than that thing, you would borrow. If that's not the case, then you are in autarky. And when you're going to your steady state, basically you're accumulating capital. The only thing here that moves along the transition, because this is a parameter, this is a parameter, and this is a parameter, is the return to capital. The more capital you have, the lower this number becomes. So if at the beginning of the transition, the capital control were high enough such that you don't want to borrow, you will never borrow. So this is a sufficient condition for having an autarky transition. Basically, if tau is larger than this tau upper bar that depends on the initial level of capital, then this economy will go through autarky until it arrives to its steady state. But if the reform decreases tau below this tau lower bar, then you will borrow and actually experience some of the benefit of the financial liberalization. Okay? So whenever I think about autarky, you have to think about a level of capital control that is higher than this tau upper bar. What is going to be a financial liberalization? Well, for the main part that I'm going to show you, is going to be an economy that is transiting on financial autarky. And when it reaches the point that it is at 60% of their capital steady state, they're going to be hit with a decrease in tau that is completely unexpected, and it's going to be brought to 0. And then we're going to compare the transition of those two economies, the economy that has this extreme financial liberalization and the economy that continues in financial autarky. As a validation of the model, one thing that we can do is to redo this kind of difference in difference, comparing data and model in respect of the macro thing that we saw before. So you see that the model can generate a decrease in the interest rate that is similar to the one in the data. The increase in capital in log differences is a bit larger because of the scale of the model. You see the change in the share of consumption in services, the share in the value added, and the things go kind of in the right direction. The decrease in the interest rate is going to be the driver of the input price channel, while the consumption channel is mostly going to be manifested in the changes in the share of consumption. And I'm going to do a counterfactual to actually separate these effects. So let me show you the immediate effect of the liberalization. So here the liberalization is at time equal to 3. In all of this graph, what you see in the blue line is the economy that is in financial autarky, that never got to borrow. So that's why the net foreign assets as percentage of GDP are 0. Now, this is the economy that got the full financial liberalization, and they jump pretty quickly to a level of 60% of debt to GDP. Why do they do that? Well, because the interest rate suddenly decrease dramatically. So the domestic interest rate decreases, and you accelerate the convergence on that respect to the long run interest rate. What do they do with these funds? Well, they accumulate capital faster. This is a bit what we were discussing with George. So in this model, just like in any model, you're borrowing, in fact, to try to accumulate capital and reach the steady state faster, but also because you were not able to smooth consumption as much as you wanted, now you can front load a bit of the consumption, and that's going to kick in terms of the heterogeneous income and expenditure elasticities. So let's look at the reallocation across sectors. So one of the main forces for the reallocation across sector is the relative marginal cost that we discussed before, as you would expect. And this is something that we discussed. So the economy is in a transition. So you see that even absent a liberalization, the relative marginal cost of manufacturing with respect to services was decreasing. But given that the liberalization accelerated the capital accumulation, you get a sharp drop in the relative marginal cost. And this is the source of the input channel, basically. At the same time, what you're going to get is that consumption is going to increase, as we discussed here. But because of the non-homotheticity, the increase in consumption is going to be tilted to the consumption in services. And what you get is that although the consumption in services was increasing in autarky transition, because the relative prices were also changing in that direction, this change is also accelerated due to the non-homothetic preference. So a lot of the change on impact in terms of the share of consumption in services is going to be coming from the non-homothetic forces. Production also changes towards services in the very short run, but then slowly it goes back to manufacturing. And this is where the trade starts kicking in. So on impact, the liberalization increases the demand and has a huge impact on the price of services. As you know, this is going to determine the exchange rate, and the exchange rate is going to move against exporters. So the worst period possible for exporters is the period of the financial liberalization. But right after that, exporters start to seeing a boost in their demand because you need to start paying the interest of the debt, and for that you need to export. So the boost on impact is going to favor services a lot. But then, as time goes by, the economy is going to start moving back to manufacturing because they need the export. And this is what I was telling you, that the short run, the medium run, and the long run effects are going to be very different in this model. The other thing that I wanted to show you is the reallocation between and across sectors. So what you have here is the relative operation cutoffs between services and manufacturing. Remember the regression where we said that in relative terms, it seems that you get a lot of entry of less productive and small firms in services. That's exactly what you get. You were in a trend to the transition that is accelerated by the reform. And you get that the cutoff of operation on services decreases much more than the one in manufacturing. The same thing for the relative entry rate. You get a boost in the relative entry rate of services on the transition. Within manufacturing, this is what I was telling you. The worst period for being an exporter is the period of the liberalization because the exchange rate moves against you. Then what you get is that the cutoff for being an exporter within manufacturing increases much more than the cutoff for entering into manufacturing. So a lot of firms exit from exporting, and then what you get over time is that that reverts. What is interesting is that the effect on impact in terms of TFP is negative. Why is that? Well, exactly because this is bad time for exporters. Whenever you shift resources outside of exporters in this class of models or outside of manufacturing to services, you end up getting a decrease in the revenue TFP. But then as resources start shifting back to manufacturers, you start getting, especially to the exporters, you start getting an increase in TFP. So the short run effects in terms of TFP and the long run are also going to be different. Let me show you now the permanent effect of the liberalization. And let me use a graph to try to explain to you why the size of a financial liberalization might have different effects in the long run. Yes, George.
Can we go back a second? So all that made a lot of sense, but it seemed like the effects were just like orders of magnitude bigger than what happened. You know, like if you look at the investment rate, I don't think the investment rate spiked like that. So have you thought about like, you know, estimating the model and like fitting it in and putting in like in some sense, the tau is a wedge. And you could always choose the tau to match the data. I mean, it's just going to scale down or scale up.
I know. So in fact, George, we have an appendix where what we did is the following. Here, this is a one-time liberalization. If you remember, I showed you a graph of the net foreign assets, the path, and they don't jump immediately, they jump a little bit slowly. So I can back up the tau needed to have that path, and basically that's not a one-time tau, it's like a tau that decreases in 3 steps. In the appendix, we have that, and then you get that these effects are smoothed out and they look a little bit closer than the data.
Yeah.
But I wanted to have a clear experiment here.
No, sure. Just in terms of taking the model to the data, it seems like very
so that's why we have that. So there are 2 ways of smoothing this out. One is with this sequential tau that we have in the appendix, And the other thing would be to mess around with habit plus capital adjustment cost. That's basically what's going on here. But I wanted a cleaner version, but you're right.
Or some trade adjustment costs.
That's also true. I could use your trade adjustment cost.
Thanks.
Very good. Okay, so let me tell you how the long run effects are come to be in this model. So remember this tau upper bar? So basically this tau upper bar was the level of capital control such that if tau is larger than that, you don't desire to borrow along all the transition. And that was a function of the initial level of capital. Of course, the more capital you have, the lower is the tau upper bar. In fact, whenever capital is very scarce, you need, you can still borrow at lower taus, okay? But at this level of tau, when you have enough capital, you decide not to borrow. So of course, the level of tau is gonna be decreasing, this threshold tau, on the amount of capital. So in all of this region, there is no borrowing along the transition. But then what we can think about is, what about long run borrowing? When would an economy support long run debt? Well, in the long run, the return to capital is going to be proportional to 1 over beta. So in fact, you have a parametric condition that tells you that when the level of tau is lower than this tau lower bar, the model can support long run debt, and you're going to have a permanent trading balance. And then what happened here in between, in this region here? Well, in this region, you're going to have transitional debt. So whenever you are in an economy that's in financial autarky and you decrease the level of capital control to region 2, you're going to get that during the transition, you're going to borrow, but you're going to fully repay before going back to the steady state. And that implies that the steady state level of financial autarky and the steady state level of an economy with a moderate reform are going to be the same. But if the reform is large enough and it carries you to the region 3, then what you're going to get is that the level of debt is going to be pinned down by how big this reform was. And if the level of debt is different across these reforms, then the steady state trading balance in the long run is going to be different. And if that is different, then the cutoff for exporting is going to be different. And all of the reallocation is going to be different in the long run. So that's basically what I wanted to show you now. So here you have 2 reforms. One is the large reform that I showed you before, the one that brings the economy right to full liberalization and has permanent effects. This never goes back. And the other one is a smaller reform where you borrow quite a bit, but as time goes by, you pay back and you go back exactly to the same steady state. The same thing is true for capital. Larger reforms implies that you're going to accumulate capital faster, but then you're going to converge potentially to a steady state with different amount of capital because your allocation of firms is going to be different. So let me show you that in a graph as a function of tau. So the level of debt in this economy in the long run is the solution to this equation. So you give me a level of tau, and I tell you what the long run level of debt is going to be. The lower the level of tau is, the larger the reform is, the more debt you're going to have in the long run. So basically what I can do is to plot the different long runs of economies that are characterized by different levels of tau. When tau is equal to 0, that's the most open economy. That's the reform that we saw before. Here, this level of tau is the one that gets you with no debt in the long run. In between, the debt is increasing up to get here. Everything is normalized with respect to the open steady state with the tau equal to 0. And what do you see here is that, of course, the long run level of consumption is going to be lower for more liberalized economies because they will have to export in order to pay for the party that they got at the beginning, this long run level of debt that they're going to have forever. What is interesting is that the share of consumption in services is also decreasing because, of course, the aggregate consumption is going to be lower, and the non-homotheticity implies that you're going to consume more services proportionally to how much more aggregate consumption there is. That also hurts the production of services because the larger the liberalization is, the more export you're going to need, and that implies that more resources are going to be shifted to manufacturing. And that's exactly what you see in terms of the mass of firms. There's going to be more firms in manufacturing whenever the economy had a larger liberalization. So that long run is going to be characterized by a more depreciated exchange rate and a higher productivity. because more resources will be allocated to manufacturing, and within manufacturing, more resources will be allocated to the most productive firms, which are the exporters. Let me go very quickly to a contrafactual in these last 4 minutes that I have. So what I'm gonna do is the following. I'm gonna compare the baseline economy with two alternative economies. One, where the difference is that the two sectors have the same capital intensity, and another one where the difference is that the two sectors have the same elasticity. So there is not, both goods are normal, basically. You go back to the CES. And just to recycle the code, instead of putting a 1, I put a 101, but this is basically the CES aggregator back in, okay? So what are these plots? So remember the typical plot of the transition that I show you. In order to have 3 lines in one, I'm gonna plot the difference between the blue line and the red line for the 3 different economies, okay? The red line here is the contrafactual that has the same income elasticity. The blue one is the contrafactual that have the same capital elasticity. Very quickly, what you see here is that typically the red line is the one that is the farther from the black line. That is telling you that most of the effects in the model are coming from the non-homotheticity. So in fact, the short run effects where you see how consumption is shifted towards services, how production is also shifted towards services, they have a lot to do with the non-homotheticity. Now, in terms of production, the fact that the manufacturing good is tradable is also key, because as you see, although this difference is large, you don't get such a difference like the one you see here. This is not completely flat. So the difference that you're getting in terms of the production, it's because the exchange rate is moving against manufacturing at the moment of the liberalization. So a lot of the short run effects are also due to the fact that manufacturing can export and services cannot. That would be, in a way, as we were discussing with George, kind of the third channel that is in the shadows here. The relative entry rate, it's also very important to explain it, to have the non-homothetic preferences. But as you see, still there is a lot to go between this point and that point. So the changes in the incentive to export also explain the changes in the entry rate and the changes in the price index. But if you had to point to one channel between the heterogeneous elasticities, it is the expenditure elasticities that are doing most of the job in the short run. And that's good because it's basically the novel part that we're bringing to the table. Now, in terms of the long run, we can do exactly the same. And here is the same tau graph, but now we're doing it for the two contrafactual economies. The message is very similar. The red line is the one that is more different than the baseline line, saying that shooting down the heterogeneous expenditure elasticities does a lot of the difference. In particular, if you were to shut them down, the share of consumption in services, in fact, would go the other way. And that I think is very interesting. Also, you get more reallocation and you get more changes in productivity in the economy due to this heterogeneous expenditure elasticity. But just to be on time, such that George doesn't bully me, let me go to the conclusion. So the paper makes 3 contributions. There is novel evidence about the impact of capital flows on service firms. I would say that this is the first paper looking at microdata from the service sector and trying to understand what capital flows do to them. Most of the other papers, or all of the papers that I'm aware of, use manufacturing firms and changes within manufacturing. We investigate 2 channels, of which one is quite novel. So we're looking at these heterogeneous expenditure elasticities, and I'm showing you through the lens of the model that in fact the heterogeneous expenditure elasticities are critical to understand the short-run effect of the liberalization, but also to understand how the size of the financial liberalization can affect the long run of the economy. So that's it. Thank you.
Okay, Felipe, great. So now we're just going to open up the floor to questions and further discussion. You can go ahead and unmute yourself and jump in, or you can raise your hand and we can go from there. So I'm going to take my MC's privilege and go first, I guess. So Felipe, this is interesting, and it's kind of related to some stuff I've done before in the past. If you go back 2 slides to your pictures with the 3 different lines on them and stuff like that. Yeah, so yeah, this one, for example. So which of these 3 lines is most like the data? I was waiting for you to show me the data on the transitions and kind of show me, here's what's moving in the right direction, or here's quantitatively what we're getting right and not getting right. What do these things look like?
Very good. So the closest thing that I have here in the slides is the table. This table, what it does, let me use this graph to show you, and then I'm going to go to the table.
Okay.
So whenever I compare model and data, what we do is we do the average difference, either in log or in level, depending, of the blue line and the red line. Because basically the idea of that would be, on average, after the liberalization, how far were you from the contrafactual economy that didn't liberalize? What's the counterpart of that in the data? Is the diff in diff. So basically the diff in diff, remember, was 0, 0, 0, then 1, 1, 1, 1. That's telling you what's the average difference after the liberalization with the contrafactual economy that never did the liberalization. Well, of course, the contrafactual economy in the empirics is plotting the trends that were coming before. And that's why I was telling you guys that we're taking into account those trends because they're part of the estimation. So that's how you extrapolate. And that's what we have here. So basically, I would say that the heterogeneous expenditure elasticities are key because you see in the data that the share of consumption in services increases. And this number, as I show you in the other slide, goes in the opposite direction or goes completely flat if you don't have heterogeneous income elasticity. So if you ask me, what is the thing in the data that we capture that no other model would, is this, okay? If the model was with more bells and whistles, estimated with the data in the way that maybe George was suggesting, I would dare to plot model and data in terms of time series. But this is a tricky beast to solve, as you can imagine. Okay.
Felipe, I had a question about, I may have just missed it, but when you're talking about the imports, you had a slide where it was showing the imports of manufacturers and then separately the imported capital. And could you make those one and the same, or was that just sort of a way to describe it, or isn't the capital just more manufacturing imports?
Yeah, so basically one of the shortcuts that we took in the model is that capital and the manufacturing basket of the imported goods are one and the same.
They are the same.
What
Okay.
I could have done is to have a production function that mixes, for example, domestic manufacturing with foreign manufacturing and builds capital. That's something that I would be open to do, or to have intermediate goods, as Jonathan was saying. All of those things would not change the main message of the paper, but it's going to change the quantitative behavior of the model for sure.
Felipe, when you use the capital share, then is it truly the capital share in value added, or is it the capital share plus the intermediate share in gross output?
Liliana, when you estimated the production function, did you use the intermediates, I think?
We use value added. So we removed the intermediates. We already used the value added to estimate to estimate. So basically what we did is to estimate the elasticities of the production function. And
Okay.
we estimated we estimated using the value added.
Okay, isn't there a bit of a hole between your model and the data and all in the intermediates? I mean, I think Hungary did import a lot of intermediates.
But if you are using the value added, you're taking out the intermediate when you're calculating things in the model, in the data basically, and in that sense, that's the way we did it. But if we wanted not to use value added, then that would be the case, and I would have to include also intermediate goods in the model.
I found the explanations pretty intuitive about the two sectors, but the part I didn't really get was what you said about productivity and exactly what is the object that you would be measuring as productivity, and or the concept in the model, or the idea in what you could measure. I kind of lost.
Very good. Let me answer first with the perspective of the model, given that I'm in that part of the slides.
Yeah.
So this is the productivity at the firm level, okay? Then what I did from the moment perspective, and you're going to see that it's the same in the data, or as close as you can get, is you do a weighted average of this object using as weights the labor share of every firm in the economy. Okay? So it's basically, imagine that you have 20 firms. They can be in service, in manufacturing, I don't care. I look at the labor of each of those firms, then I look at the share of their labor with respect to the whole economy, and I do the weighted average with that. That's the way all the literature of Haltivanger, Foster calculates, in fact, from micro to macro productivity. In the data, and Liliana can correct me if I'm wrong, after she estimated the production functions, she can back up the productivity, which in this case is revenue, TFP, at the firm level, and then those numbers, she weighed them using the labor share of the firm in the same way I did. That's basically it.
Yeah, but there is a kind of issue there, because in the data, you don't see the fee parameter. I mean, you across firms, there's no such thing because they're producing different stuff. There's different prices. So I guess that's where it might be good to think through that. I kind of understand you, the way you explain the theoretical side, I guess makes sense to me. And so when you were saying in the model, productivity goes down, it was a situation where the high fee firms were kind of losing market share relative to low fee firms, and then it kind of reversed or something. But in the data, that may be a little, there might be kind of a glitch there because of the fact you don't really see the physical when you're looking across.
What I can tell you is that the estimation is done at the 4-digit levels, but even within 4 digits, you're right. It could be that they are producing things that are different, but this is as much as we can observe. There is no more detail than that.
But you're using revenue as the left-hand side variable, right?
Liliana, I think that the answer is yes.
Sorry to interrupt. For the firm level data, we use value added. The only important thing is that when we use we use real value added when we estimate the production. If I remember correctly, I done this long time ago. When we estimate the value added and the elasticity of the production function, we use real value added. And when we deflate using 4-digit price index.
Okay.
So it's quite disaggregated. And we use, and we have, so for value added, we have the value added price, the price index of 4-digit of value added. But we also have it for materials, producer price index for materials, and producer price index of producing goods at 4-digit level. So it's quite disaggregated. So it's true, we don't have price level at the firm level, but we don't have prices at the firm level, but we have 4 digits. So it's the best that we can get with balance sheet data, I guess.
George.
So I found this interesting, but it seems like there's kind of 2 things you guys are doing. One is these non-homotheticity, and then there's some stuff on the firm level, which is really interesting. The non-homotheticity I'm a little bit unsure of, in the sense that, one of your targets is, after this reform, we see the consumption share in services go up, but we know that the consumption share in services kind of moves around over the cycle in a lot, empirically, and we write down lots of models where the consumption share of services varies over the cycle. When I look at your model, like the way that you get a big shift into services is through a huge boost to capital. So in some sense, kind of the elasticity of consumption services to income is way too, is it high or low? In your model, it's way too low compared to the data. So it seems like there's some other force that's kind of operating that you would like to sort of have in the model to kind of tease out whether it's really the non-homotheticities or some sort of business cycle thing that's going on.
But the expenditure elasticity, we take them directly from the literature that has estimated them.
No, but
we don't target anything for
you're
those.
Kind of looking at this over the cycle, right? I mean, in some sense, you're putting in a shock that leads to a big boom in income and spending in Hungary. And so it's not clear whether the cross-sectional results are important for for the business cycle movement. So for instance, in the data, the consumption, just looking at your table, the capital share, let's say that's a proxy for wealth, goes up by 6% in the data, and your consumption share goes up by 1%, whereas in the model it's 1% and the capital goes up 3.5 times that. So I'm just trying to understand like how much is really from the non-homotheticity versus maybe some other business cycle factors that could be at play. Maybe it's all comes back to the same question. It'd be nice to kind of estimate the model over the cycle. Maybe it's just a comment.
Yeah, I don't know. It's something that I have to think a little bit more. Yeah.
Because in some sense, like I'm thinking about the paper Sam and Jonathan and Brent and Romales had, where they're kind of doing a similar exercise, but they're fitting the data and they've got shocks to like the different sectors, right? And in some sense, they're going to fit the data. You're just kind of endogenizing those shocks a little bit. And I kind of want to know how much is coming from like the cycle versus the shocks versus the model. It's nice to be able to endogenize those shocks, but there might be other forces as well.
Yeah, I'm not taking the approach of putting wedges in the model and trying to collapse the data. That would be like another way of doing it, basically.
Yeah. Okay, that's just a comment. And I'm not a bully.
For the record.
For the record. I feel like I have to say that.
Yes, Felipe, how are you?
Well, good, Cecilia. Good to see you.
Good to see you too. I have a question. A very nice paper, very clear results. The question I have, I guess, is the same as Carlos, which is what did the reforms consist of? Because they didn't move from autarky, right? There was already a negative net foreign wealth. Is it something about the private sector being able to borrow relative to the government, in which case should we be concerned about that trade-off between government and private sector? What was the reform? What rules changed?
Okay, I think that Liliana can give you better details, but basically the slides that was promising, so that you see that I was not lying, is basically the one that you see now. So basically it was a restriction on the banks to intermediate funds. So there were restrictions in the spot and the forward market for FX. And the idea is that all of these instruments were basically banned. You were not able to use them. So that makes the international borrowing costly and very illiquid. And the way we try to think about this is maybe you had a little bit of borrowing, but you saw the impact that you have on the NFA. So that's basically it. Of course, that's what I was saying. This is as close as we get in macro to a quasi-natural experiment. But that's basically the reform. I don't know if Liliana wants to add something.
No, I think it's basically that. So basically the way, so there are many ways to put capital controls in an economy. Like emerging markets are very creative at that. And basically what they did is something that many emerging markets do, and I think Brazil have done at some point, is that you shut down the derivative markets and you put limits in the spot market. And what this makes is to reduce banks' ability to intermediate foreign funds. So it makes it very costly for banks to bring foreign funds into the economy. And this is very important for a small economy as Hungary, because most of the inflows come through the banking sector. So basically what they did is to shut down that when they shut down the foreign exchange rate market. And in 2001, just they regulated all that. So in the sense, what is good about this financial liberalization is that there is really a liberalization of capital flows. Like it's not FDI, it's not trade, because this was deregulated in '95. So it's just financial flows. It's how banks being able to bring in more money into the economy can bring more money to the economy and expand the credit supply and expand the economy. That's the main thing.
Yeah, so then I guess linking to Carlos and Jonathan's question, suppose a firm in manufacturing wanted to import the inputs, so then it would have to buy exchange rate through the spot market. And were they allowed to do it? How did that work?
That's a good
Because
question.
otherwise, then it's a direct effect on intermediate inputs costs.
It's a good question. I think, as much as I understand, if you wanted to import, there was no big restriction on that. I think so. The main idea is that what they wanted to restrict was financial flows, especially short-term financial flows. But everything that it was FDI, or if you want to import all that helps the real economy, they didn't regulate that. So they would allow you to bring money for that. Like, or if the foreign company wanted to bring money, they will allow it. What they didn't want is to have like mutual funds or pension funds like bringing a lot of money, like a short-term financial flows. Like they think of this, all these reforms were in the 2000s, where you have a lot of crisis in emerging markets. And this was, so what they wanted to evitate is these sudden stops. So basically that's it.
Okay, thank you.
Kim, you're muted.
I'm done with the question.
Yeah. Some things you just never learn. Any other comments or questions?
I have a quick one.
Yeah, Jonathan.
Dan Corbin and I were in Hungary a number of years ago in happier times. One of the stories, but it was after the recession, but one of the stories about the liberalization was that a lot of Hungarian households took out loans, mortgage loans, mainly in Swiss franc, which then when the recession hit, created, in the Swiss franc appreciated, created huge havoc. Now, I guess some of that is kind of here. I guess real estate is in services, capital stock and services includes housing capital stock. But it'd be kind of interesting, given the fact that at least that story was very much out there, if the model might just look at that a little bit more. And there might have been a fixed asset. Land is a fixed asset. So there might have been a land appreciation effect as well that most of these sorts of models don't have.
Yeah, that's it's a good point. So let me answer from the part that we can. So what you see now in this slide is if you look at the top 15 industries in terms of net entry. Just remember, part of the idea was that you're going to have a lot of entry in services, and it's going to be in particular in the services that have high expenditure elasticity. And what you see is that the number one in terms of entry, as you were predicting, Jonathan, was real estate activities, so things that are related to the markets of housing. It's not only that, there is things that you would expect as restaurants that have high income. You need to have money to go to restaurants and stuff, but it is up there. So part of that story is there, and it's informing progressions. Now, going back to your point, that I hope can be a next paper, like extending the model to have housing and try to understand mortgages, I think could be something interesting, especially given the richness of this data. But I would do that in a different project.
Thanks.
Okay, so I think I'll take the moment now to officially wrap this up. We're certainly happy to stick around and keep talking. Just two quick announcements. So there is no seminar next week. So this is our first break since we started back in March. But next week is the NBER Summer Institute, and we figure you guys have enough Zoom calls to sit on. But then the week after that, we'll resume again. Ariel Burstein will be presenting. And then just maybe one more programming note. We're planning on going to at least the end of August. We're not sure exactly if we want to keep doing this once the semester starts, because I know several places are going to be starting up their own local seminars again and doing them online. Certainly any feedback on that would be great. You can just drop us an email or just say hi and just an opinion of whether you think maybe we could drop to doing this just once a month or every other week or something. It'd just be good to know what people are thinking about, or even kind of what your seminars are looking like for the fall. We're trying to figure out at Wisconsin what how we're going to run it as well. So thank you everybody for coming, and I will see you in 2 weeks.
Thank you.
So Felipe, let me ask you one more question.